Welcome back to Investing Talk Podcast.
Today we're looking at VIVK.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. We're tackling a fascinating case today because VIVK really presents this major dichotomy.
A dichotomy, how so?
You've got this incredible operational strength on one hand, but it's running headfirst into some, let's say, significant capital structure volatility.
Okay, so a classic good news, bad news story. Let's start with the good news then. Where does that story begin?
It really starts with a truly exceptional financial snapshot from the first quarter of 2025.
And when you say exceptional, you mean the fundamentals were just, screaming positive news.
Absolutely. We're not talking about marginal growth here.
Yeah.
Revenue surged 133% year over year.
133%.
Hitting $37.3 million. I mean, for a company in the industrial logistics sector, that is just staggering momentum.
And what's critical there, I assume, is where that growth came from, right? Was it a one-off thing?
Exactly. The key driver wasn't some sudden temporary contract. It was solid accelerating performance in their transportation and logistics services.
So it suggests their core business is maturing, that the market is really buying in.
It does, but it's not just the top line. The efficiency is what really caught my eye. The profitability jump is even more startling than the revenue. Gross profit increased by a massive 345%.
345% in the same quarter.
In that same Q1 period. That leap in gross profit tells you they've really optimized their operations. It's not just selling more, it's selling more, efficiently.
Which you can see in the margins, I bet.
You can. The resulting gross margin was 12.5%. In the refuse systems and logistics sector, a margin like that, it speaks directly to strong pricing power and really excellent cost management.
Okay, so when we look at that margin, we have to consider their place in the market. Why VIVK? What's their competitive edge?
It ties directly into what analysts are calling their sustainable competitive moat.
Their moat.
Yeah, they focus heavily on refuse systems and industrial materials transport, which, often requires specialized handling and terminaling capabilities.
Right, stuff that not just anyone can do.
Exactly. VIVK has built a dominant position, essentially cornering the market in certain areas because of their unique logistical network and terminal infrastructure. They can manage complex material flows that competitors just struggle with.
And that translates directly into that strong margin.
That's it. They aren't just moving boxes, they're managing complex industrial waste and resource flow.
It makes sense. If you control the necessary infrastructure, you can dictate the pricing. It gives them leverage. Okay, so operations are strong. Let's unpack the balance sheet, because growth means nothing if the company is drowning in debt.
And you'd be surprised. It was actually pretty conservative, especially given that rapid expansion. Their total debt-to-equity ratio was sitting at just 0.54.
0.54. That's quite healthy.
It is. It signals a strong capital structure, a lot of flexibility, and their total assets are substantial. They're approaching $248 million.
So strong operations, great margins, controlled debt. And yet, when I look at the stock price relative to those assets, it paints a very confusing picture. They look really undervalued.
Very undervalued. The price-to-book ratio is currently sitting at just 0.36.
Wait, 0.36. So price-to-book measures the market price against the company's net asset value. A PB below 1 suggests the market thinks the company is worth less than if you just sold off all its parts.
Precisely. It suggests the company is basically priced at liquidation value.
But they just posted 133% revenue growth and 345% gross profit growth. Is the market missing something huge, or were they pricing in a massive risk we haven't gotten to yet?
That is the core tension of this entire story. That 0.36 PB signals huge potential upside, but it also suggests deep skepticism about the sustainability of that growth, or, like you said, the expectation of future dilution.
Okay, so despite that discount, the structure seems strong enough to generate robust free cash flow, which is key for innovation.
Exactly. And that financial strength, it definitely laid the foundation for the technical momentum we saw earlier in 2025. After that Q1 report, the stock moved. I mean, it really moved.
Including that huge spike,
like
right?
A 25.32% spike on May 30th alone. That was the market finally waking up to the fundamental news.
But that action set a really clear bullish trend. Higher lows, higher highs. For momentum traders, the short-term picture looked great.
It did. And the underlying indicators are even more telling. We need to know if that May run-up just exhausted all the buying power.
Right. Was it overheating? I mean, the stock's trading above its 50-day and 200-day moving averages, which is a good sign. But what about the oscillators? What's the momentum health look like?
So if we dive into the specifics, it looks more like controlled accumulation, not some frenzied speculation. The 14-day relative strength index, the RSI, is sitting at a neutral 32.75.
Okay, explain that for everyone. A 32.75 RSI, what does that mean in practical terms?
It means that even with that huge price surge in May, the stock never got into that overbought territory, up around 70 or 80. So it suggests volume could spike again without immediately hitting a wall of exhausted buyers.
So there's still gas in the tank. What about the stochastic oscillator?
Even more interesting, the stochastic is sitting really low at 17.88.
Which suggests it's potentially oversold on a short-term basis.
Exactly. It's poised for potential rebound. When you pair a neutral RSI with a low stochastic, it suggests that even a small piece of good news could trigger a sharp upward move.
And that aligns with the confidence signals we were seeing from inside the company. We saw clear insider buying trends.
We did. Management was putting their own money to work. And on top of that, institutional inflows have continued to increase. The big money sees the upside, and so do retail investors. Analysts have been upgrading their targets too.
Okay, but this is where we have to pivot. We have to put on our risk management hats now.
This is the turn.
We've painted this incredibly compelling picture, but the capital structure has gone through some profound turbulence since then. We need to talk about the risks from this recent restructuring.
This is the critical pivot point for anyone looking at this company right now. The growth story is real, but the ownership structure has been fundamentally altered. The company has executed multiple registered direct offerings.
Which is a way for a company to raise capital quickly, right? They sell shares directly to institutions.
Exactly. And the scale here was significant. In October 2025 alone, they raised over $11 million in gross proceeds.
$11 million. So that's much needed capital, but it comes at a price.
A very high price. It substantially increases the outstanding share float. For an existing shareholder, that's dilution. Your slice of the company just got smaller.
And that wasn't the only source of dilution, was it? There was also debt conversion activity.
Yes, compounding this, the company's lender converted parts of a $6.625 million junior secured convertible promissory note into almost 14 million common shares.
Okay, so let's break that down. The lender is trading their debt for equity ownership.
Right. For the company, that's good long-term. It cleans up the balance sheet, reduces liabilities. But for existing shareholders, it's like a second quiet dilution bomb flooding the market with new shares.
It shows the lender has confidence, they'd rather be an owner, but it creates huge short-term volatility as the market tries to absorb all those new shares.
And beyond capital raises, they're also dealing with ongoing liabilities. We've seen settlements for outstanding claims with structured payments.
I saw that. There's cash due in January 2026, and they also issued stock in November to resolve some claims.
And using stock as payment tells you two things. One, litigation is ongoing, and two, there is real pressure on their working capital that they're trying to solve without using cash.
So the bottom line on this whole section is what? Massive potential for short-term volatility.
That's it. High risk. The market is still absorbing this huge shift in ownership.
So we have this dichotomy. Phenomenal growth versus serious balance sheet restructuring and dilution. The whole thing hinges on the next few quarters. What catalysts are coming up?
The most immediate focus will be earnings. We have two key dates: the Q4 preliminary announcement on December 23rd, and the formal Q4 and full-year results around February 15th.
And those reports are the first big test. They'll show if the growth continued and, more importantly, what the new share count does to earnings per share.
They have to prove that the money they raised was put to work effectively, that it generated growth greater than the dilution.
And beyond the numbers, what operational updates should we be watching for?
Look for new product launches, partnership announcements, expansion of that logistics network. A new major terminal contract, for example, would be a very strong signal.
Okay, and on the market side, January is a big month for tracking institutional movement.
It is. The major ETF quarterly rebalancing window opens around January 2nd.
Which could create some unexpected trading volume.
For sure. Especially if VIVK's new profile forces index funds to adjust their holdings. And then you have the big reveal. The institutional 13F filings are due around January 12th.
That'll show us what the big funds, the BlackRocks and Vanguards, are doing. Are they buying into this restructuring or are they getting out?
Their actions will tell you everything you need to know about how the big money views this dilution.
And looking further out, what about long-term drivers?
We're focused on things that strengthen that competitive moat. So potential M&A activity, strategic alliances, expansion into new markets, anything that provides sustained structural growth to counteract the dilution.
Okay, let's talk about the chatter. What are the market rumors that investors need to be aware of?
One of the more credible ones involves a high-level strategic partnership. There's talk they might pursue a joint venture with a larger commodities or environmental services firm.
That would be a game changer. It would be a huge vote of confidence.
It would be exactly what they need to reassure the market after all this. And related to that, there's talk about asset sales.
Selling off non-core assets to raise cash without more dilution.
Precisely. To shore up liquidity and improve the balance sheet. And finally, there's the most controversial rumor.
Let me guess. A reverse stock split.
You got it. With the increased share count and the price pressure, some sources have floated the possibility. It's a way to artificially raise the share price to maintain their exchange listing.
But it doesn't fix the underlying problem, and investors often see it as a bad sign.
It's a key risk you need to be aware of, for sure.
So to sum it all up, you have this incredible growth story, but it's battling serious restructuring and dilution risks.
It is. The immediate future is a high-stakes balancing act. The next 3 months are absolutely critical.
It's not just about revenue growth anymore. It's about capital execution. Investors have to watch how management deploys that fresh $11 million. Can they grow the core business fast enough to overcome the massive increase in the share count?
If they can, the bullish case is strong, and that deep PB undervaluation could correct itself in a hurry. If not,
the dilution becomes a heavy, debilitating burden. The takeaway for you is clear. This is not a set-it-and-forget-it investment. The operational success is proven, but you need to continuously monitor their capital deployment and watch those institutional filings. If they manage this transition well, the upside is huge. If they fail, the downside is severe.